Hey everyone, and welcome again to the channel. So, you're probably here because you're thinking about the question everyone wants to know. Is real estate investing even worth it in 2025? And I get it. With all the hype surrounding high interest rates and a crazy market, it's easy to be unsure. But here's the thing. The answer this year is not an easy yes or no. It's a heck of a lot more complicated than that. 2025 is a transition year. Quite frankly, a bit of a paradox. The old paradigm of just throwing money into any property and hoping the whole market goes up, that ain't gonna work no more. Success this year is all about being strategic, doing research on particular local neighborhoods, and being flexible. And that's what we're going to dissect today. To see where the opportunities lie, we first need to see the big picture. And the thing to know is that the market isn't moving in a single direction. On one hand, some sectors are definitely healing. We're seeing strong fundamentals and renewed confidence in certain markets. But on the other hand, other areas are facing some serious structural headwinds, like the massive affordability crisis and big demographic shifts. So it's not a uniform market. It's a mix. Some parts are recovering nicely, while others are struggling. Our goal is to navigate this complexity with data, not just speculation. All right, now let's go into the engine room of the economy, the Federal Reserve. This is a humdinger with regard to borrowing costs, so pay attention. First, in September of 2025, the Fed finally cut its first rate cut, dropping its benchmark rate by a quarter point to between 4.0% and 4.25%. Second, their now famous dot plot forecast envisions 2 additional cuts within the year, lowering the median rate to about 3.6%. So why did they do this? Effectively, they're reacting to a softening job market, but with inflation still in the vicinity. They're trying to walk a very thin tightrope. But here's where things get complicated. While the Fed is in charge of short-term rates, what actually counts in real estate are long-term rates, such as the 30-year fixed mortgage. And on this, the pros are completely divided. Fannie Mae is fairly upbeat, predicting mortgage rates will finish the year at 6.1%. But JP Morgan takes a more conservative view, saying rates will only come down to 6.7% and won't even dip below 6% in 2025. This is more than an argument, but it is referencing a fundamental conflict. The Fed is trying to stimulate the economy, but other forces, like persistent inflation and vast government deficits, are pulling long-term rates to stay higher. So, in some ways, investing in 2025 is a bet on where you think these long-term interest rates are headed. And speaking of those forces, let's talk about the two behemoths, inflation and growth. Inflation is still stubborn. The CPI is expected to rise 3.5% this year, which is not even close to the Fed's 2% target. While economic growth is low-keyed, we're looking for real GDP expansion of perhaps 0.7% to 1.6%, which is hardly sizzling. This creates a challenging mix. Property is generally a great inflation hedge, but if the economy is slow, that can be bad for tenant demand and cash flow. It's this mixed outlook that makes choosing the right sector absolutely crucial. Now, this is counterintuitive. Despite brutal affordability, housing prices have continued rising. Why? Because of a powerful, insidious force called the wealth effect. Research shows that for every $1 increase in housing prices, consumers spend approximately 5 cents extra. It may sound tiny, but the reality is, American housing prices surged by a whopping $3.3 trillion in the first 9 months of 2024. That translated to a staggering $165 billion stimulus into consumer expenditure. This feedback loop should then recur. If there's another 5% price rise in 2025, it could lead to an additional $120 billion of expenditure. This is a humongous silent stabilizer for the economy. This is partway to explaining the biggest paradox in the market now. Why is it so strong if affordability is so terrible? The reason is that the market is totally bifurcated. We're split in two. Meanwhile, you've got homeowners on the ground. They're sitting on huge amounts of equity and have very low mortgage rates from a decade back. They're financially buffered. They can draw on that equity or even buy down a new mortgage rate, allowing them to keep making deals. This gives a floor to home prices so that they don't bottom out. On the other end, you have first-time buyers who are completely priced out. So the market is not collapsing because an entire category of people are just not feeling the pain. Let's quickly ground this in some of 2025's hard numbers. You can look at the estimates all over the place, and that says it all about the uncertainty. Home prices? Estimates range from a modest decline of 0.9% to growth of 5%. Mortgage rates will be somewhere between 6.1% and 6.7%. Existing home sales will be between 4 and 5 million. This set of outcomes is the reason that a one-size-fits-all solution is bound to fail. And that brings us to the home price paradox. Take a look at these forecasts. iShares is positive at 5%, Goldman Sachs is steady at 4.4%, but Zillow actually forecasts a modest decline of 0.9%. This illustrates the oldest real estate truism. All real estate is local. National averages are increasingly an artifact of the past. One figure can't possibly capture what's really taking place on the street. And here's why. While other markets like Detroit, Toledo, and Cleveland are seeing wild year-over-year price appreciation of 14% to 17%, other previously red-hot markets like Austin, Miami, and Chicago are seeing pretty big price declines. This divergence even extends to rents, which are flat or falling in some of the top metros. The takeaway: succeeding in 2025 is not timing the national market. It's about performing granular, market-by-market due diligence to find those islands of strength. You've probably heard of the lock-in effect, and it's the defining feature of the 2025 market. Over 80% of homeowners have a mortgage rate that's at least 1 full percentage point below today's rates. They have zero incentive to sell and give up that cheap loan. So you'd think inventory would be super low, right? Well, it's actually creeping up. The number of homes for sale was up 10% year over year in August. But a closer look shows why this isn't a crash signal. Homes are sitting on the market longer, a median of 47 days, which is 8 days more than last year. This isn't a flood of supply. This is tempering of demand because rates are high. The homes are there. They just aren't selling as rapidly. Lastly, let's deal with the human side of this, the affordability crisis. This is not a market dynamic. This is profound social change. Working with the median house price, a household needs to have at least $126,700 in annual income in order to pay for a home. That installment takes up about 30% of the median income, one of the largest percentages in 25 years. And simultaneously, over 50% of renters are now cost-burdened, paying in excess of 30% of their income on rent and utilities. It's putting an entire generation out of reach for home buying. But to investors, this crisis is a powerful, self-sustaining cycle. Here's how it goes. High housing prices push potential homeowners into the rental market. That increased demand increases rents. All those higher rents just make it even harder for people to save for a down payment, trapping them longer in the rent trap. It is a structural shift that creates enduring, long-term rental demand. To investors, it is a gold mine. Here's a snapshot in August 2025 nutshell. Median sale price was just slightly more at $439,894, but fewer houses sold. Inventory is 10% greater, but new listings are down. And houses are lingering on the market 47 days. That's the face of a slowing, cautious market. And where does that leave us in terms of action steps? Long-term rental property would seem to be one of the top places for 2025. Target markets with solid fundamentals like diversified economies and job growth. The analysis names winners in the Midwest like Toledo, Indianapolis, and Kansas City, and in the Southeast like Huntsville and Tampa. But a caveat: a record number of new apartment buildings are coming online in 2025, especially in Sunbelt markets. This could result in oversupply in some markets. So careful local research is not a luxury in an effort to avoid saturated markets with new units. What about fix and flip? That's a much tougher game now. 88% of the flippers report having high levels of competition for deals, Acquisition costs are up, and consumers are very price sensitive. Profit these days means being resourceful, finding off-the-shelf bargains through direct mailing or wholesalers. The opportunity may be in emerging second-tier markets in the Midwest and Northeast, where fewer of the big house builders are competing. This is a high-stakes, high-grind strategy that's not for the faint of heart. Now, commercial property is facing a gigantic challenge. A gigantic $1.8 trillion in loans falls due in 2026, a debt cliff others are referring to. This will potentially lead to distress and forced sales. The office space is actually suffering hard, with the vacancies standing at an all-time high of 20.1%. CRE is not homogeneous, however. While office suffers, other forms of property perform, such as industrial warehouses for online retail, grocery-anchored malls, and specialized niches like data centers and elderly housing. For practitioners, the debt cliff may offer a chance to buy distressed property at a discount. If property work is a nightmare, there are passive options. REITs, real estate investment trusts, let you invest in real estate like it was stock. They're diversified, liquid, and need no management. And better still, they beat the S&P 500 by about 4% when the market was volatile in early 2025. Additionally, fractional ownership platforms are making access more democratic. For the price of $100, you can own a part of a high-end property. This is revolutionary for time-constrained or capital-constrained investors. Here's a quick rundown to give you a sense of what is right for your style. Single-family rentals require high effort and capital, but are suitable for income. Fix and flip has high risk with no passive income. Commercial property requires extremely high capital. And REITs provide low capital requirements, high liquidity, and are extremely passive. It all just depends on what you want and have. So let's recap this using your 2025 playbook. First, think local, not national. Your success relies on hyper-local evaluation. Second, leverage technology. Use AI platforms for management and analysis to get ahead. Third, embrace the rental revolution. The affordability crisis isn't going away, so grab the demand for rentals by the horns. And fourth, seek niche opportunities. Look to alternative markets or properties for aging in place and multi-generational living. So, is real estate investing still worthwhile in 2025? The short answer is yes, it remains attractive. But those easy money days are over. Success now belongs to the strategic thinkers, the well-educated, and the adaptable, to those who navigate beyond the sound bites and master their local market. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.